Saif, thank you very much for being on my show today.
Thank you for having me on your show.
You are the co-founder of Sehteq, which is a digital insurance, healthcare insurance startup based in Dubai. Prior to this, you were the CEO for Middle East and Africa at UnitedHealth Group, which is obviously a Fortune 500 company, and specifically, I checked this morning, number 6. So it's one of the largest health insurance companies in the world. And before that, you were with Aetna, Daman and Green Crescent, AXA Gulf. And you, I believe, continue to hold an advisory position with UnitedHealth as Chief Medical Officer, Global Payers and Multinational Employers Business at Optum, which is their UnitedHealth company. And you're also a physician.
Yes, I am.
So you're a proper doctor. So I should have introduced you as Dr. Saif Al Jabeiji, or you worked prior to that also with the DHA, I believe.
Yes, I did.
So 2 years ago, you started Sehteq, and this is a insurtech startup. Would you call it an insurtech startup?
I would, yes.
Yeah. And so can you tell me about your journey? How did you get around to starting it, and what was the vision behind Sehteq?
The idea was born in an incubator, in a startup incubator. So I'll take you a step back. My friend and co-founder Hisham Safadi and I wanted to start an entrepreneurship hub where it's a combination of, let's say, commercial, like any other incubator or accelerator, but also with government support. So we partnered with the Department of Economic Development in Ras Al Khaimah, and we launched RAC, Ras Al Khaimah Incubator and Accelerator. And that was in June 2017.
So you launched your own incubator for other startups?
Absolutely. So that's how it started. I wasn't that much involved. I was more like the chairman. I'm an entrepreneur that wants to be an entrepreneur, so I didn't understand much. I spent some time in Silicon Valley, and I liked how all of those incubators work, and the spirit, and the entrepreneurs, and how they help each other. So we wanted to do something similar, but has a commercial agenda. So the companies that we would incubate, it's more, I'd say, realistically will make some money. So you support them, but will not look at an exit. It's more like businesses. And the goal was only 40 companies. So it's small.
So your goal was to be an incubator for companies that became profitable ultimately?
Yes. And in that journey, since we launched, as I told you, like 2-3 months down that line, with all the talks about mandatory health insurance, expanding to include Northern Emirates, which is mandatory in Dubai and Abu Dhabi a few years ago, the idea of creating a digital health insurance company in Ras Al Khaimah to prepare for the mandatory health insurance was born. And then what we've done, as you've rightly said, I've been in insurance all of my life. It's something I'm passionate about. And I have a lot of friends who work with me in insurance and continue to work with me. What I get out of the experience with the incubator is a lot of IT experts, or I'd say innovators, who brought nice ideas. They have a good track in development and marketing and etc. So simply I'd say combine both and you get Sehteq. So we have the legacy insurance expertise with all of those non-insurance experts who sits in the incubator, and through a process of, if you're familiar with the Google Startup Weekend, is where we met many of the talents we have, some of the startup shows and etc. So the idea was launched by the government of Ras Al Khaimah, as you call it. We continue to call ourselves a digital health insurance platform. In the mature world, they would call it an insurtech. And that was in November 2017.
Specifically, Sehteq is incorporated as a TPA or an insurance company?
That's a very good question. So it was first launched out of the incubator as more or less, I'd say, an insurtech or an IT company. And that was in November. In Feb, where we started the real operation, that's Feb 2018, is after looking at, are we a broker, are we an insurance company, are we a TPA? And then, as it's very difficult to sell health insurance, it's even more difficult to control the administration of what you sell. So it took us 2 to 3 months to figure out what we want to be, and eventually we decided that we are a TPA. So we acquired our first TPA in 2018. Until a month ago, we continued this acquisition path. We bought 12 companies, including 3 licensed TPA and 2, what they call them, HMOs. So it's a step down of a TPA. And with that, now we have a model where we focus a lot on designing a health insurance product, selling that health insurance product with partners, and using technology, so online and offline. But more important is how do we administer and manage what we sold and look at the retention. So the consumer is, I'd say, in the heart of what we do. What's, I'd say, a key factor is we are not a disruptor. So Sehteq as a company, it's digital, it's InsurTech, but we work within the legacy system. We try to improve it every once and then by talking to, I'd say, the bigger players on the market and making sure, even we talk to the regulator, making sure what we do is cool and nice and brings a lot of value and return of investment, but we don't breach any of the regulatory framework.
I think your acquisition strategy is fascinating because I don't think anyone has done this in the UAE before, and I'd love to pick your brains on that and learn about that a little bit. But before that, I'd just like to touch upon one figure that I read. You have 500,000 members at the moment.
Yes.
On your platform.
Yes. I mean, I can't hide my smile.
That's a huge number.
It is. But when we started, and I can share with you the first, I wouldn't say even board presentation, but in the first presentation we have a photoshopped piece of a newspaper that says Sehteq hits 1 million consumers in 2020.
Right.
So that's always on my office. And then what we've done, we worked back. So we want to have 1 million consumers in the UAE market, and then what do we need to do? So obviously you have to come up with good products, work on partnership, but acquisition came as a good idea. Out of the insured population, the health policies in this market, many of it is administered by TPAs. Okay. Mm-hmm. And when you look at the licensed TPAs, there is 2 or 3 that have the majority of the market, and a very small companies who competes on bits and pieces of the market. So the strategy was to acquire all of those companies, kind of like bring them together into a single platform and built on it. And this is what we've done. So we reached the 500,000, of course, with the good efforts of the team I work with, but the acquisition helped us a lot.
So the idea is that you buy out TPAs and integrate them to your platform, which is tech driven.
Yes.
And I also read that 40% of your P&L goes towards tech resources.
Absolutely. I mean, you look at not only the investment, all the meetings that happen, whether at the shareholder level, at the executive team, is about how could we look at the technology and bring it to insurance. And that technology, let it be, we all order food from Talabat or take a cab with Uber and Careem, and this is what we look at. It's like we want to have the experience very similar. We don't look at InsurTechs or the legacy system and try to fix it and, let's say, replicate it, but we literally look out of the market and bring the idea. And that happens with the balanced approach of very smart guys from out of the insurance, and the checks and balances that happens with the ones who have experience. And then, as I told you, I always, on a more, I'd say, friendly basis, or even officially during the office hours, I'll try to go to a regulator and tell them this is what we are doing, as many of those regulations are built in the maybe 70s and 80s, so it doesn't look at what's an InsurTech and how would the relationship work when you sign digitally or do the declaration over a mobile application versus papers. And so far they've been very helpful. It's all about talking. I think my experience working with the regulator before helps. So we look at the regulator as I'd say more like a support. We look at the industry as support.
Have you seen regulators change policies or adapt certain stances based on, what you're trying to do?
Not really, but what happened, a good scenario is as we've been acquiring companies and changing the licenses first, but then we will eventually merge them into a single license. But during that process, you'll have now multiple licenses that have the same name. And I'd say for the region, if not globally, that never happened. You have multiple insurance companies for some time that will have the same name and to an extent the same shareholders. That drove now a new discussion with the regulator. How do we do that? I mean, do we keep them as this until we merge them into a single license? Do we follow the individual license? So like they will tell you, you cannot have that much equity in a company if you have equity in another company. So some of that regulation is built around public companies, like the insurance company is more about the board structure, but on ownership and InsurTech, it never exists. And so far we're making a progress. Again, by working with the regulator, not by like saying, oh, this is an old document, you have to change it. It's more like we look at that old document and see what we can do.
Staying on integration, operationally, how do you manage to, because, to me, we're talking like apples and oranges. You're talking about buying the relatively smaller TPAs
Yes.
that have pretty much, correct me if I'm wrong, but pretty much been competing on price, working with the smaller insurers. And you've kind of bought them out and you're plugging them into this state-of-the-art platform that you're building that is futuristic. So how does that work? And has that been successful? And how long is this really going to take?
So we try to challenge ourselves. We acquired the 3 companies in June, and I said we'll do like 100 days. So we have a WhatsApp group that says 100 days plan, and in that group, that within the 100 days we will have to integrate all companies into a single platform.
So we're talking about 100 days to integrate like 5 companies into one company using one bit of tech as its core.
Not only that, so it's from call center. So now if you dial any of the numbers, you'll get a centralized call center. As I told you, from a legacy regulation, you'll have to press 1 for that company, 2 for the other company. But you will get the same answer. So it's the same team sitting together. And then you talk now about the core systems we are using. So we started by bringing everyone together. It's a commodity at the end of the day. So you have health insurance. You expect service. So first, we've established what kind of service we want to give you, and then we drove this down and had all of those companies comply with that. So it's not the opposite. I didn't look at what each company can do and cannot do, and let's come to a consensus. We said, this is what we want to do. Now, how do we do it?
But each company has different kind of products and network benefits.
And people and legacy and way of doing business. I think among all of those, I'd say technology is the easiest. We keep on investing even more and more into technology. And technology, you can sort it. You can buy it, you can leverage it, you can lease it, you can integrate. This is not my main concern. Honestly, if you will ask me 3 months ago, I would say, yes, it's a tough job. We need to invest in technology and bring everyone together. But what was really a surprise is people management. Once we get all of those companies, the ones who were acquired first, somehow they thought, they acquired the other companies. So when we go and do an acquisition, unfortunately that culture will continue to happen, but usually the new guys are looked at, we bought your business because you were not doing well. And there is a lot of work happening in terms of bringing everyone together, that we are now one company, we have one vision. I don't care if you were an X or Y and Z. And to be honest, within the 100 days, I think today we are day 80 or something, it's not that easy.
Are we on track?
We are on track. So I invited you. We are celebrating on the 17th of October. And we'll bring everybody to show them that we've done it in 100 days. And I think that's the only way. Otherwise, it could take years. And I've seen it in my corporate experience that integration could take years. And you will always get people who would say no. What also helped, we brought, in the past week and the next couple of weeks, we brought fresh bloods, new people who have never seen that company or this company, in a new team from the market who has enough experience to lead the next chapter. And that's why we went a little bit public. I'd say so far for the past year or so, we've been under the radar, never talked to anyone. The only reason I had a couple of posts on LinkedIn is when we wanted to hire good people as a startup, and you would approach someone who's been in the market for so long, they would say, I know you, Saif, I'd like to work with you, but I've never heard about your company. What helped us a lot is we were ranked 9th globally as an insurtech.
Really? Wow.
Yeah, and again, it's like we just shared that, guys, we are number 9 outside. And in the UAE, there was a recent study done that we ranked number 5 in terms of, so insurtech is different. So insurtech has completely different way of looking at what's your tech, what's your people, what do you do, how successful you are. But we're number 5 as a legacy insurance provider. So we competed with that with the big companies like NextCare, Nas Neuron, even insurance providers like Daman, Aetna.
Looking at, the fact that you're looking to hire people, presumably the companies that you bought out had some good resources that you could integrate into your central operation. Is that something you're doing as well, or do you find that it's best to have an outsider's view?
I think there is beyond, I'd say, the experience those individuals have. They also have the corporate memory or the company memory. And some of them been with the company for 12, 13 years. And as you rightfully said, those are small companies where it's not everything is documented. Some of it is, they promised someone over an email or text message. So for the first 2 months, I gave an opportunity to everyone. As a chairman, I'm not an executive in the company. I'm more like I look at the 360 view from a 10,000 feet level. So I said, okay, well, this is what we want to do. Everyone has an opportunity to continue to work. And some of them did fantastic, like surprisingly fantastic. Once that become more like a bigger pond. Others, no, they're still struggling. So I'd say for more than 2/3 of the 100 days, we let the company run by the individuals that we inherited with acquisitions. But then I brought those expertise because they've seen how work is done at a larger scale. So someone from NextCare, for example, they are used to the hundreds of thousands of lives. Someone from Neuron, they are used to the best quality in customer service, right? So those we would never have them from the existing teams. You'll have to bring them from outside.
I need to ask you about redundancies. Naturally, that's something that will happen when you're operating in a model like this. And of course, a lot of operators, when we meet, fellow insurance industry colleagues, everyone talks about them, there being too many players in the market at every, too many brokers, too many insurers, too many TPAs. So, you're doing the dirty work in a way of cleaning things up and actually building a proper organization to service the TPA segment. But this would obviously also come at the cost of redundancies. So how do you deal with that? Do you have is it happening a lot? And what's your approach to it?
Well, there is no formula how would that work. It all depends on how the market perceive it. But I wanted to share with you a joke. Now we've been labeled as cleaning the market. So the companies that are struggle, they will either call us or someone would recommend that they will call us.
TPAs are reaching out to you?
Yeah.
To get bought out?
Which I'm happy with it. It's what we established, but it doesn't mean that it's our mandate to buy struggling companies. No, we will do if it makes perfect sense. So back to redundancy, there isn't any of those acquisitions. Sometimes there are some unique points within the company. One of it could be the portable membership they have. So if they have clients that we can move into our platform. And then in most of the cases, I'd say when you look at the infrastructure, there is no much to reuse. You get the challenge a little bit around people, okay? Where I'd say in terms of the acquisitions we've made and we will continue, this is a bigger challenge as you are getting a replica of what you already have.
Yeah.
So a claims manager, now we have 4 or 5. Approval or a call center agent, now we have plenty of them. I think partially what we're trying to do is to see if we can reuse people. So and obviously all of those management tricks that you find on LinkedIn or any book, you would do trials and errors. So we're trying to know the people, as insurance is not an industry you get out of school.
Yeah.
Some people were looking, they were selling something else. They came to the UAE, they worked in insurance, they liked it. We have a lot of people who came from banking. Yeah. So at the end of the day, whatever they are doing or they were doing, it doesn't mean that this is the only thing they can do. So it's a lengthy exercise, but we've been successful in looking at individuals who were doing something else, like call center agent, who eventually can be beyond call center and work on as an analyst or vice versa.
Yeah, and find ways for whoever that can add value to the organization.
But this is the toughest thing, and I've seen it especially with. We have, and we will continue to have succession plans. So there's always young entrepreneurs who will come work with me or with any of the CEOs of the companies, and I test them when it comes to that. It's like you will have to make hard decisions. Sometimes it's good to let someone go. Mm-hmm. If he's struggling, and he was like, let's say, a manager in company A, now we are bigger, he's still stuck in that mindset. I tell people that works with me, my colleagues, like, it's easier to let him go back to a smaller company where he can continue to be the boss of the bosses in a small shop. But what helps and will continue to help is when you look at how other industries are working. So you mentioned we are all in insurance, right? But there are different components in insurance. A brokerage doesn't run like a public joint stock company, which were 150 million, or an insurtech or an app. So we try to look at those other lines of insurance and how they work, and then the lines that are similar. Fortunate or not, but now there is a lot of good resources in the market. They are available, they have experience, and then you have the wider markets where you can bring in resources.
Doing some mental math, it sounds to me like you bought 12 companies in 6 months?
A little bit more.
A little bit more. So how did you manage that? I mean, buying a company is no small thing. You need to do the due diligence and assess all of its liabilities. And again, as you said yourself, you're known a little bit for buying the more struggling type of companies. So again, that's a scarier thing. How do you get so much done so quickly? And would you do this? Looking back, would you kind of go down the same route again?
I'll start with that. Looking back, I wouldn't wait all of this time to do the acquisition. Most probably we would have bought more by now.
Really?
Yes, I'll tell you a joke. Most probably once we watched this video, one of my very dear colleagues who work with me, we were driving out of an acquisition. He said, I'll create an acquisition manual. And I said, would you please hold to this idea because we will share it. He said, we keep acquiring companies. We should have a manual. So once we acquire a company, that's what we do. 1, 2, 3, 4. And I told him if I share this with my colleagues in the industry, they would think we are bluffing. But as you said, the number of acquisitions we've done make us right now more of an expert in that area. It's extremely important to know those are individually owned businesses. Some of them legacy. When I say a license that is 14 years old, it means someone was working on it for a couple of years before, so you're more like buying their kids. So it's not a straightforward process in terms of bringing E&Y to do a due diligence.
Did you do the valuations and things yourselves?
No, I'm blessed to work with both a team who's full-time, but a wider team who I call them the advisory board. And those are experts like yourself, being in the market, and we're not buying industry from an industry that we don't know. Like most of those companies, we would know more about them than sometimes what they know about.
Through third-party references?
Absolutely,
insurers.
References, the market, the providers, the brokers. So we will look at that part, and then what you really need to dig down is once you go into the company and see what's, as you call it, the liability, the dead bodies that buried, but we deal with it.
Did you find a lot of surprises?
Oh my God, yes, of course. And by the way, some of those surprises, I'd say even the owners didn't know about.
So are there any regrets? Are there any mistakes? Like, are there, from the 12 companies you bought, are there like a couple that you shouldn't have gone into?
I could change the model. So we went into the two-step approach. So we'll buy a company that we'll keep the owners first, okay, and then we'll dilute.
So you give the owners a management contract for 3 years or something like that?
Not really, because they are not key people. Some of them might not like it, but they were running these companies as an owner and executive, which doesn't work. You'll have to differentiate. I could be an owner of the company, but if I want to have a role, I have to have a contract and defined role. I can't just come once a week and change the decoration of the office because I didn't feel good that day. You have to be the CEO to do that, right? Or maybe even the administration manager to change the setup. So there was no much, I would say, of need for them to continue, but more like in terms of due diligence. So instead of doing very deep due diligence, we're keeping them in the business for some time. So if you discover...
So you're acquiring a stake as opposed to the full buyout?
I call it a two-step approach. So I'm telling you, we're buying the business. Okay, for the first 6 months, it will be a partial acquisition. Once everything is okay, we will continue the acquisition. That's a struggle because for some of them, then they see it now getting better and there's like, I don't want to sell the rest of the shares. But it goes with that quick acquisition mode. And as I'm telling you, we haven't reached yet to acquisition of structured companies. This is now the second phase. As we are almost close to buying all the small local players, we will buy the regional ones, and that will most probably be a merger rather than acquisition. Where, as you said, like I would want to keep the CEO on a retainer, on a contract. He has to stay. He's a key person. Maybe I want to keep the CFO, even one of the owners who are hands-on, who's been into the business. And then those companies might bring some value that we don't want them gone. We want them to stay. At the same time is the nature of ownership. Many of these businesses own individually, so they would want to be into the business. I've done a post on LinkedIn maybe 2 months ago with a photo of the 3 companies we bought. And literally I get calls trying to sound modest when I say it, but people will call me and say, what does it take to be in the next photo? So as those smaller companies, the ones that we compete with on day-to-day basis, they see the value of becoming one larger platform rather than we compete and eventually the bigger boys will win the deal.
Yeah, like you were saying, there were many of them were disrupting the business in a negative way.
You're right. Or competing on price only.
Yeah.
But you can only create, so when I'll take you back to investment in technology, you cannot do that if it's a small business. This is why we needed the million consumer, because at a million consumer, my 40% P&L will be huge. So I can buy in internet companies, mobile application, wellness companies. It will all make sense as you have a huge consumer base in a relatively, I'd say, small market.
To do what you're doing I'm sure it takes a lot of money and a lot of capital. So what's your approach to that? I know you're VC funded. Is that correct?
Yes.
Presumably you'll have to kind of keep raising a lot of capital going forward, or is the plan slightly different?
No, it's slightly different. So that VC is a friendly VC. We don't have a VC startup kind of pressure to sell, or there's no talks about selling. Okay. The VC would help us structure those acquisitions or growth in a nicer way. So where you can split the shareholders and owners from the day-to-day management. The plan is right now is we're more or less, I'd say, we're cash positive, we're sustainable. So
you're cash positive already?
That was from the first couple of months, yes. Yeah.
Health tech startup or health insurtech startup, and you create a company at the end of 2017?
Yes.
And you become cash positive in a couple of months?
Yes.
But you still have 40% of your resources in tech?
More than that, maybe.
So is there some secret?
So whatever we built in tech, what's important to know, we don't build it for us. So we built it in a way that it's extremely expensive, it's really good, but I know other companies can use it. And this is not a myth.
Other TPAs?
I wouldn't say TPAs per se. Yes, some TPAs or competitors would use part of our tech, but a lot of the ecosystem uses our technology. So that makes the investment in technology has an ROI by itself. Yeah. And this would help us also expand to markets where I don't know. You and I were in Bahrain, and right after that conference, I was asked if I'm interested to come to Bahrain market, and we are not. But we will lease, let's say, or share our tech, our model with a company in Bahrain that will run with it, I wouldn't say as a franchise model, but to an extent, that's how we will expand. So back to that point, what we do is use technology to reduce and standardize the way we operate. Okay, so out of the 500,000, I'd say I have roughly maybe 50, 60 people running that. Much probably people would say this is not enough, including the team. They would say we need more. We need to scale the number of resources we have, because they do their calculation based on what they've seen in their previous work. So company A, they have 1 million, they have let's say 400, 500 people servicing that 1 million consumer. Company B have more than 1 million, they have 1,000. So you see the scalability in terms of people goes bizarre. You are a small company, you have 20, 30 guys working for you. Once you become big, you have hundreds of people, and then supervisors, managers, senior managers, etc. In our case, there's no secret sauce, but you look at technology and how it would sort that. And you look at the humans and decide what the technology cannot do, so I have to hire that guy to bridge the gap. So they have to be more expensive guys that can solve where technology struggle. This have helped us reduce the operational expenses, but also build a new revenue stream. Okay. Now you look at the growth and the revenue. Partially, it doesn't only come from acquisition, but when you acquire your competitors, you kind of like neutralize the market. So I no longer have to compete on a dirham or 2 dirham price. It will be, let's say, 2, 3 players in the market, and you, Mr. Client, you have one of those 3, 4 options. You no longer have 70, 80 options willing to compete for 1%, 2%. So that will also help. Obviously, yes, the business was run to be profitable from day one. So shareholders have to get their money back, employees have to be paid on time, small vendors that we work with or a startup has to be paid even in advance. So we will not replicate the model that in the insurance industry, payment is delayed, so I have to delay payments for the whole ecosystem. One of the companies we acquired was struggling with paying providers. So I reached out from my office to all providers and said, listen, we understand that this company didn't pay you. It's an open invitation. Come with your invoices. We will settle it. And I'd say that even increased the liability. You're telling people, hey, listen, you have liability with one of those companies. Come, let's talk about the liability. We'll not hide our heads and say, we bought this company, I have no idea about the liability, and you know what, I'm sorry for you, go chase them.
Did you buy out companies that have liabilities that far exceed the assets?
Yes.
So what does that mean? Does that mean that they have to pay you?
Well, there's a couple of transactions, but it's a line of that. They will have to pay. If they want to have a decent exit, if they plan to stay in the market, they will have to do that. That's another challenge. I mean, you could just close the company, and there is a company that closed. The owners are here in the market, and the liability they have to us and to others is enormous. And
because they can't just declare bankruptcy here, right? Yes. So they need to figure it out. They need to settle those liabilities, and that's another kind of maybe in a way a value proposition for you, in the way that you can help them get there more easily.
It could, but this is not our model. We are not going to focus our time, efforts, and energy in cleaning up company unless there is a value in that company. So some companies, as you said, they could have liability, but still they have a good portable portfolio. They have clients who loves them. It's just financially they didn't know how to run the show. So if you can move those individuals into another platform and then clean, that's okay.
So the main goal is acquiring customers through these acquisitions. Right. I want to shift focus a little bit to product. Globally, what we've seen a bit of a trend in that MGAs are working with insurtechs, or insurtechs are becoming MGAs, working with reinsurers themselves to seek capacity and then create their own products, and in a way cutting out insurers. Do you see value in that proposition?
It really depends. So you have some insurance companies that look at the medical book as loss-making, too much headache, very regulated, but still they are an insurance company, so they have the license to write business. And those are the best partners when it comes to that. So you are partnering with them by using expertise and investments you have to drive a win-win. So they have the top line, they have the clients, they have the revenue, they make profit, and this is a line of business they have no interest in. I don't see it happening when you compete with serious players like the AXAs of this world, AXA, MetLife, my employer, UnitedHealth Group. Those are serious about health business. You cannot just bypass them and go to the reinsurer.
But you see yourself as working with a multi-insurer approach, where you continue being the TPA or the administrator. I mean, how do you see your role evolving over time? Do you want to get involved in underwriting and product, or distribution is another thing I want to talk about? Or do you see yourself or Sehteq as a business that continues to create efficiencies in the process of delivering health insurance benefits?
Well, I would look at it as we are an ecosystem by itself. So we have a product, the product we design. So we design in terms of benefit, we study the market with all of those legacy companies that we bought. As I told you, the youngest one is 10 years old. So there is a lot of utilization and market knowledge that could exceed what some of the insurance companies know. And the data is in the millions, as you know, every year you have renewals and you can understand trends. So that helped us design a product. Now the difference between an insurtech or a small fish versus a large company, that initially we designed 16 products. We saw only 2 are selling. Scrapping those other products took a click. Large insurer cannot do that. You cannot design so much products and you cannot then take them out of the market, because some people will lose their job. In the insurtech world or in the startup world, it's okay to fail. Let's try and fail. And by the way, throughout this 16, 18 months, we failed many times. Like we launch something, doesn't work, we re-scrap it. We do more, I'd say, within the startup, we do like what a startup is good at. We do proofs of concept. So we launch a product, limited the product with one client, they test it and they say, this is horrible, guys, don't you ever launch it. So we design the product, we underwrite the product, and this is why we have 12 licenses. There are different business setups. Some of it is owned, some of it is a joint venture, some of it is a vendor-client relationship. But for you as a client, I will give you a product that you chose. you designed yourself. You've seen transparency on the pricing. There is no fine print. You know exactly what's covered and what's not covered. And then once that product is sold, so there is a fintech involved that processes the payments within the regulatory framework, which you would understand as a broker. You cannot touch the money, but you're doing the sell. So we will help you. How do you do that? And how to ensure that you have access. You know who in your team have sold that product, so you calculate his commission.
So does it make sense for you to work with multiple insurers? Because if it's your product, they're effectively fronting partners?
To an extent, not necessarily fronting. Some of them, they help us in the design as they understand their consumer base. And
they also bring capacity as risk takers.
Absolutely. It could be shared risk. However, one of the models that we wanted to change, that TPA should not just process and pay claims, right? We are hired as a TPA in concept to manage care. So if an insurer or an individual client or a corporate client, they just expect the company to pay their bills with no approvals, prior approvals, or no intervention in the trends management, then we tell them, well, why don't you get credit cards and give to people? The idea is we don't only process, right? We have to earn the money we're making by looking at how that works. And this is, I'd say, a huge gap. You have a couple of TPAs in this market that are known to process very well. Zero complaint. Everything is paid. But then the insurer or the reinsurer...
That takes a toll on the...
Absolutely. The reinsurer will, at the end of the year or second year, they'll say, we burn our fingers in this market. We are no longer staying because no one have looked at the sustainability, right? So it has to be a little bit of a skin in the game. So the product, as I'll bring you back, the product is co-designed based on the market client need with a lot of lab kind of. So we are looking at the way Singapore and Hong Kong design products. We'll bring them here, work within the regulatory framework. If it works, we'll launch it at a larger scale. We'll look at how telecom works, how the additional distribution channels, so not only brokers and agents, but something beyond that. But it's extremely important that, okay, you've done all of this investment in acquiring a customer. Now, I have to make sure that my service level is up to the liking of that customer. Right now, Sehteq as a company is more like a micro-insurance. We focus on an income level between 1,000, 2,000 dirham up to maybe 10, 15,000 dirham. With that, you have two lines of insurance, either the basic plans, which is 500 dirham, or we call it the enhanced basic, that goes to up to 2,000 dirham. So that's what we do, that's what we are building a service level around. Now, you look at the wider scope. What about people earning more money and interested in a higher insurance plan? Obviously, this platform we have is not set for it. So we need a second platform that built around someone making 15, 20,000 and has a certain expectation when he uses insurance. He wants dental to be there. He doesn't want to wait. So we're looking at delivering the medicine to your home, concierge service, booking your appointment. Obviously, that category, they use their mobiles and applications a lot. How can we leverage apps that will help you? Not just have an app then you would never use, but an app that will add value to you. So the product design is driven by the segment, the population that we want to serve, and then you drill it back and you stop. What I've also seen, there's a lot of failures in the market when companies, they're so good in servicing a clientele base, and like they are more luxury retail, and then they want to service the mass. They'll miserably fail, and vice versa. When it's not a known brand, it's a new company, it's economic, and then suddenly you launch a new lavish product with concierge and you expect people to buy. They will not buy it because brand equity is extremely important in our market. I don't know about the rest of the world, but over here when you say Munich Re, AXA, you say MetLife, you say Aetna, immediately you say, oh, great service. It might be fluctuating, but still the brand has an equity. When we understand, we're realistic. It's a new company, less than 2 years old. We are doing well. Our prices is acceptable. It's extremely easy for brokers and agents and also individuals to buy our insurance. You go, it's literally 2 clicks. You pay the money, you get your insurance, and it's active instantly. So no wait, no delays. You can literally buy the insurance on your way to the clinic, and then it will work and we'll do it.
Let's talk about distribution. Currently, I think a lot of the business that you're doing is broker-driven or sourced from brokers.
Yes.
How do you see the distribution strategy for Sehteq evolve over time. Do you have a direct-to-consumer or even direct-to-corporate approach, or do you see yourselves working with brokers going forward, and I know strategic partners as well?
Simply, when you look at this market, the way it's been working, more than 80-90% of your business will be driven by brokers. So there is no point of changing that. This is what I told you. We respect how the market works. So what we do so far, we are a B2B2C.
Yeah.
So I will empower you. All of our application could have your logo. So if you don't want your clients to see me, I'm okay with that, as long as I'm getting eventually the business. Now, there is a segment of the market that likes to go buy directly. It's primarily individuals and SME. And the brokers knows about it. Few of them have done what you've done and created a platform for that individual business. But the majority of brokers likes to focus their efforts, teams, and investment into large corporation. So for large corporation, we are set. We have a client relationship management team. Those who are in their previous career worked primarily with the brokers. So they know what the broker wants, they will give them what they want, they give them broker support, and most of that is done offline. Legacy, the same way you would deal with any insurance company. Okay. In the back end, we support them and there's a broker with technology if they like to use it. Now, you have other distribution channels, including broker, that are very much into technology and system integration. So we've done two options. Either we'll integrate with what they have, if there is a lot of value and there is, I'd say, a lot of resistance to use our technology, or the other ones, we just white label our technology and it becomes theirs. And this is working very well. Okay. For that small population that still is going online, we have a lot of thoughts, forward and backward. Should we go B2C? Should we continue to be a B2B2C? So, and this is where the other agencies comes, like the telecoms, whoever owns a distribution channel or a website that drives traffic could be a partner for us.
So by 2020, you're going to have 1 million members. That's done. 5 years from now, what is Sehteq doing? How big is Sehteq? What's the vision?
Well, the vision is, I think, will come once we exceed 1 million and we have this model working well in the UAE. Obviously, the UAE market will be too small to us. There will be no expansion. We cannot continue the double-digit growth and all of those nice and buzzwords that people use with VCs. So we'll have to go to another market. However, personally, we don't have 5 years of plan done by PwC or Ernst & Young. It's the plans that are done mainly by the advisory board and the shareholders. But what we would want to see is much probably work with a strategic partner, maybe one of the large reinsurer or one of the larger brands that would help us take as much as possible from that model, which is considered, the UAE is heavily regulated and difficult and competitive. So if you figure out what you want to do within the UAE market, it won't be that difficult to figure out what the other markets want. So step one will be working with interesting partners to explore the region where we don't do much, but then eventually we will want to look at a market like Saudi, because Saudi is the market. And a lot of the work that we are doing right now is eyeing Saudi. So we will test the technology, send it to friends in Saudi and say, what do you guys think? And they'll say, no, this will not work. It's too complex for Saudi market. Simplify it more. And that would be where, let's say, a strategic partner like a global player will add value, because they know those markets and they could benefit from our speed to market. They might have data from those markets. So that's one, I'd say, of the vague, maybe this is what will happen. But I think the UAE market for us, beyond acquiring 1 million consumer, is how do we retain them? How do we give them a differentiator is extremely important. The reason we want to reach 1 million, not to sell once we reach 1 million, is it would justify that if we launch a new application, we have a sizable population who would test it. And if it's good, we know if it's good. If it's not good, we know it's not good. It also would help us if we want to design special products. So you have a sizable population who are South Indians, or a sizable population who are from Egypt, right? So I could, within that sizable population, launch a new product.
Thank you very much, Saif, for talking to me today. This stuff sounds really exciting, and I'd like to congratulate you on achieving so much through Sehteq in such a small amount of time. And I'm looking forward to closely tracking your journey. And yeah, once again, thank you for being here.
Thank you for having me in your show.